We have a great panel here set up that we're excited to get started on today. Before we get into that, I'll do a quick introduction of myself. Brett Eichenberger, I'm an assurance partner with Cohen and Company, also the practice leader of our registered funds group. Cohen and Company, just to give a quick background, is about a 600-person accounting firm with offices in Cleveland, Chicago, Milwaukee, Pittsburgh, Detroit, New York, and Baltimore, and work with a variety of industries and businesses. Specifically, I'm involved in our registered funds practice where we provide audit and tax services to over 950 mutual funds, ETFs, closed-end funds, interval funds, and business development companies, which actually makes us the 5th largest auditor of registered funds in the country. And actually, with respect to ETFs, which we're going to talk about today, we're the 4th largest auditor of ETFs in the country and actually work with more ETF advisors than any other accounting firm. So very excited to introduce my panelists today. With me, we have Sonia Formato from Foreside and Mike Castino from US Bank. Sonia, do you want to go ahead and introduce yourself?
Sure. Thanks, Brett. And hello, everyone. Good afternoon. Glad to be here. So as Brett said, my name is Sonja Formato. I'm with Foreside Financial. So Foreside provides distribution and compliance services to open-end and closed-end funds, exchange-traded products, commodity pools, and private placements. We pair comprehensive and customized advice with best-in-class technology to help our investment management clients continue to innovate, improve, and grow. So from an ETF perspective, we have over 100, as of, I would say as of May, at the end of May, we have over 180 billion in assets under distribution across 55 trusts and 122 issuers, as well as 600 funds. So my role specifically is to work with our clients and partner to kind of share best practices around distribution and the landscape, as well as to continue to build relationships with the intermediaries. Glad to be here today.
Thanks, Sonia. Mike?
Thanks, Brett. And hi, Sonia. And hello, everybody. Good afternoon, good morning, good evening, wherever you're at. Here at US Bank, we are a global custodian and administrator. Along with those two items, of course, comes accounting and transfer agency. Specifically, in the ETF space, I currently work as the business development officer here at US Bank, helping both existing clients and anyone who wants to utilize our services find the right path into the ETF space. And of course, that brings us here at US Bank quite often into contact with our friends at Cohen, our friends at Foreside, and our friends at Sunstar.
Thanks, Mike. So we're going to talk a lot today about launching an ETF, selecting the best wrapper for your product, and then we're going to talk about marketing distribution with respect to ETFs. So I'm going to kick it off actually to start with Mike. I know there's a lot of different ways to launch an ETF, whether it's going white label, going within a established multiple series trust, or launching your own trust. I guess I'm curious on kind of an overview of each one for our attendees today, and then kind of the couple of the pros and cons of each of those different ways of launching an ETF.
No, sure, absolutely. So maybe I'll caveat that first by saying whether it's our team here at US Bank or independent third-party counsel, please definitely always check and verify what's the best structure for you. But at the highest level on the 1940X side of the ETF world, you're exactly right, Brett. A trust comes into play, and it has a lot of different names. White label trust, series trust, shared trust, standalone. But basically what that means is there's a regulated investment company or a RIC under the 1940 Act that's been established with a board and officers and all the proper third parties, such as a medallion distributor in the ETF space, audit and tax firms, third-party legal firms that will perform all the roles necessary to make sure that you, if you become the advisor, have the ability to launch your funds, your ETFs in that trust. Now, that's where the term series comes from, right? Because every single ETF or mutual fund is a series of that trust. So the real key to the structure is determining those roles, meaning, do you want to be the advisor to those funds or to the series of the trust, or do you want to work with someone who will represent you as advisor? That's where the term comes in white label. That firm will actually be the advisor representing you to the trust, and a standalone trust isn't anything different, for example, as a shared trust or a white label trust. It just simply means that you went out and put all these pieces together and registered with the SEC, and you are the advisor running the whole thing yourself. Now, I'll say one other quick thing on that. Talked about the white label where someone represents you, a standalone that you build specifically for your own purposes. That third category, Brett, that you mentioned, sometimes called multiple series trust, is in reality what we might call a shared trust. It's multiple advisors bringing their own funds. In years past, you'd bring your own relief, but we'll talk more about where that's needed and not later. But you come in and you represent yourself as an advisor, and you share the trust with other advisors. Therefore making it more cost effective to you and operationally efficient to share all of those necessary requirements to run your ETFs or your series within that shared trust.
And what you mentioned there with respect to exemptive relief, I mean, let's talk a little bit about timing, right? So I'm wanting to launch an ETF product. What's my fastest route to launch a product? What are the timeframes with respect to doing it myself, going within a series trust, and then, you know, with the ETF rules specifically, how do I know whether I fall under the ETF rule requirements or whether I have to go and get exemptive relief 19B4, that type of process?
Right. Yeah. So I think if we take the 19B4, for example, we can just kind of get that one out of the way specifically because that relates to the listing exchange and what they have been granted to list or not granted to list by the SEC. So if the product you're bringing to market doesn't fit what is generally known as generic listing standards, then the exchange on your behalf would petition the SEC through the 19B4 process to be able to list your shares on their exchange. So we can kind of button that one up and put that in the realm of the listing exchanges for them to more fully develop if someone needs more info on that. But if you go back to what is necessary what is needed to have exemptive relief and what's not, a general rule of thumb right now in the industry, if you are fully transparent, i.e. not fully non-transparent or not semi-transparent, your holdings are known on a daily basis, then you fall under what's generally called the Rule 6C11 ETF oversight, which basically means no relief is needed. You go back to that first topic and you say, standalone trust, find a white label advisor, or potentially act as advisor and join a shared trust. The other side of that equation, with all of these new forms of intellectual property that are revolving around non-transparent and semi-transparent, those you will need to petition the SEC for exemptive relief. The good news there is that field's been plowed already. You wouldn't be a guinea pig in that area. So generally it's almost like a template form of relief that many legal firms can do for you.
Okay, so as long as you fall under, some of the traditional products that fall under the relief, the timing with respect to going white label, series trust is about the same, and maybe a little bit longer if you're going on a standalone basis, just because there's more, because it's your first time filing, there's more things that you need to do with respect to, a seed audit and initial registration statement, things of that nature.
Right, absolutely. Yeah,
So,
we just touched the surface on those. Like I said, there's plenty of good lawyers and legal teams out there that can help you really dig in. So,
sure. Sonia, let's. Mike mentioned a little bit about the various structures. The wrappers. We have semi-transparent. We have full transparent. We have non-transparent now. ETF wrappers available. Can you talk a little bit about? I run a strategy. But I'm really interested in launching, say, a non-transparent ETF. Does that always make the most sense, or do you really need to kind of look at the strategy that you're looking to launch your particular portfolio and then decide which structure from a wrapper standpoint that you're going to go into?
And Brett, that's a great question and helpful to build upon what Mike has already shared. I think first off, you want to make sure that the marketplace is looking for whatever you're thinking of bringing to the market. I do continue to see, launches out there. What I think initially the first considerations need to be about, do you have demand for the product and is there need for it in the marketplace? Because that's going to be key long-term as you're talking through marketing and distributing that product. critical to grow scale and to continue to build upon, your great success. From the structure perspective, I think you have to think of a number of different things. With the semi-transparent or non-transparent coming to market, what's been great about that is that has really allowed asset managers, mostly equity asset managers who previously didn't want to dip their toe in the water and leave a mutual fund structure, to be able to launch an ETF and still protect their intellectual property and not disclosing daily their portfolio holdings. So that's definitely been the talk of the town, and every other Ignites article that's out there, and ETF kind of trends. But there is still, kind of great work being done on the active, transparent side. So I think it's really depending on what you're bringing to market. If you're looking to shield those holdings from, kind of your secret sauce from someone front running that. I mean, if you look on the active side and who's had success, I mean, ARK has had great success and they're fully transparent. And it's just, what they're bringing to market is they feel, they can share that. There's been a lot of active on the fixed income side. So I really think it comes down to taking a step back, the type of asset class you're coming to market with, what type of kind of transparency are you comfortable disclosing, and then how are you going to get there is really putting the pieces together. If you're going to need to license one of these new models to really kind of shield that, or you're going to be able to go fully transparent, or you're a passive fund that is an index provider that can obviously launch a product that is not going to need to be concerned on the active side. So I think there are a lot of considerations, but that, as Mike said, just scratches the surface for the two things going on right now.
Mike, anything to add with respect to that?
Oh gosh, I mean, I think the most important point that Sonia is making is you're not going to tell the marketplace what it wants. You just can't do that. I mean, we've seen that too many times where, they're going to love us. Just wait. I mean, how many funds and families have not made it because of that? And Sonia, I don't know what you think, but I find that the ETF space is very receptive to people reaching out, pre-launch or pre-discovery, and just asking them whether that's a specific wirehouse or regional broker dealer or even a large RIA family. Go ask them what they want. And
absolutely, Mike. And I think that's where you really need to think about overall your kind of product pre-launch in the planning and the product development. Who am I as an asset manager? What am I bringing to the marketplace, regardless of what vehicle I'm bringing it in? And if you have great relationships with the wirehouses or an RIA, or in fact on the primary market side, talking to the trading desks around what they're seeing, what are they trying to solve for? What do their clients need? And instead of trying to just retrofit and think what you do well into the marketplace, Mike, as you just said, let's think about this together and bring a solution to market that's going to help their clients, because then you're really going to have that initial demand that's necessary and that ongoing demand, because if one's needing that, there are other folks out there amongst the 300,000 plus advisors that are trying to solve for the same things. And I think that brings an interesting conversation even to build on that. I know it's not part of the question, but when you start seeing all the trends of what's happening, the big things coming out of COVID and all the interesting products that there's been demand around have been these thematic that have crossed sectors. They're really dabbling in a little bit of everything, and folks are getting energized around, the new ETFs have a lot of, active investors that are individual investors. They also have, financial advisors who are looking to help their high net worth clients with tax efficiency. But it's been really interesting to watch the trend around these thematics. And, every time, Mike, we're talking to clients and common clients, you're hearing cannabis or you're hearing AI or, so it's a lot of interesting things going on, in addition to great managers doing things in the traditional asset classes.
Yeah, I mean, Brett, I think the very last thing I would say on that is I'd rather bring the right product in due time than the wrong product in a short amount of time, because you know the results there. So,
but Sonia brought up a great point, which is almost that the ETF is becoming a technology play, and that the product is very efficient, both from a trading standpoint, which we'll get into, from a tax efficiency standpoint, which we'll touch on a little bit. But that's, the marketplace has become very receptive, and the investor base has changed over time with respect to ETFs, and we're seeing a lot more, retail investors in the products. I want to go back for a second because Sonia, you kind of brought it up. We've developed what type of product we're going to bring to market. We have our strategy. Now we have to find capital with respect to launching the product, right? It's a little bit different from a mutual fund, in that, you have to have your initial creation of the product. Mike, do you want to talk a little bit about that environment for seeding, where you're going to get your AUM from? Is it in-house captive already in your management company, or are you going to go out? Let's talk a little bit about the funding of the ETF product.
Yeah, absolutely. So I think you can break it down to the basic components, right? You hear the term lead and seed, for example. To get a fund out of the gate, you need a lead market maker after you choose your listing exchange. And then we'll need that seed capital per the exchange's requirements to get that fund off the ground. And obviously that translates into a certain amount of shares. So traditionally, it used to be 100,000 shares at a $25 NAV, which most ETFs came to market. Obviously, the math there is 2.5 million in seed capital that you would hope that your chosen lead market maker would put up. That's quite a bit of money on anybody's balance sheet to kind of tie up and hope that you would get out of it. Now, the exchanges have been granted the ability to bring product to market at lower share thresholds, sometimes as low as 10,000 shares. So that requirement has gone down to obviously the lowest level, about $250,000 in some cases. So the burden is taken off of going out and asking for that 2.5 million from the lead market maker themselves. Now, you would think that would make things easier, but even sometimes you'll get someone to say, I will be the lead market maker if you find somebody to be your seed partner. To your point, Brett, you can do that internally. You can have money that you can use to put into the creation of those shares prior to launch to have that inventory. Or there are other ways that you can, let's say, compliantly and legally take somebody out of their seed shortly after launch. Again, another whole side conversation. The second part I'll just dabble on really quick and then just kind of toss it back to Sonia on this one for your expertise. But you're talking about that long-term AUM that's going to sustain the ETF itself. Do you have captive AUM within your firm that you can dedicate 25 million, 50 million? Do you have a third party that says, we'll put 100 million in? Are you creating a bespoke ETF for someone that says, we'll put 500 million in? You've got that captive in-house, but then the other side of that equation is if you don't have that, you're going to have to go out and capture it with a well thought out plan.
Yeah, and I think that's key there, Mike. You bring up an excellent point. Regardless of what you capture in the beginning or what you seed it with, that well thought out plan and kind of that approach to the market is critical for success. It needs to be in place way before you start thinking about kind of the launch. And that's going to be important both on the primary market and on the secondary market when your sales folks are going and talking to those, financial advisors. I would say another interesting thing to bring up that Mike kind of mentioned, there's so much going on here. We've heard a lot too with the first mutual fund to ETF conversions. Bring your own assets in the sense of I'm converting over a structure which I feel gone through the whole process and I feel it's going to be better in an ETF wrapper. Now that's not for everyone and there's a lot of interest. We've talked to a lot of asset manager clients since Guinness Atkinson and both DFA have, kind of made kind of a splash this year. That being said, it's a very lengthy process. There's a lot of considerations that go into that. This could be in a webinar on its own. There's strategic considerations of, will my strategy fit in the wrapper? Can I manage it, in an ETF? To the governance and factors around that, as well as additional operational requirements. It's a comprehensive project that needs to be managed and ticked and tied as you walk through it. I think in a lot of ways, we have a lot of clients on this, webinar who have mutual funds. Now, mutual funds are still predominantly a large slice of the pie. They continue to grow. They're not going anywhere. I do think, you know, they're seeing a lot of their success from a lot of the 401k plans where ETFs can't go. So I think there's a lot of things to think about there, but definitely another way to bring over assets that folks are starting to think through of bring those assets over and start at a scale so that they can move forward and grow from there.
Yeah, and Mike, I know you're probably having a lot of those similar conversations with respect to converting a mutual fund, or even we're having conversations with a number of folks that talking about converting, you know, an SMA accounts to an ETF as well. And, you know, I guess, Mike, what are some of the operational items that you're working with clients through with respect to, you know, if they have direct accounts and how you're getting those onto an intermediary and things of that nature, and some of the other items that you guys are dealing with from an operational perspective?
Yeah, so I think if we talk about let's say a private fund or a hedge fund to ETF or an SMA to ETF, that's a little bit less of a lift, obviously, than a mutual fund. It's a little bit smoother. We've done that several times for clients. And, you know, obviously it's all about trying to make that event tax-free for the shareholders themselves. So there are some hurdles that you do have to look into. It's not just automatic that on a 351 exchange, for example, in the SMA world, you can just check that box and move everything over. So there is some preliminary steps, but operationally it's easier, as you mentioned, than a mutual fund to ETF. And of course, that what you're talking about is there's different share classes, there's different types of shareholders, there's legacy record retention that you have to deal with, even though the mutual fund sunsets and is closed, you still have a TA component. So you have to have a well thought out project plan. You have to look into what's the makeup of the share classes, for example. Are you going to need to collapse them? Number two, can you get to all these accounts? Let's just talk about that broadly. Can you get to every single shareholder? Now, again, this is regardless of whether you're going to do this by board approval alone or go out to proxy. Okay, that's a whole other debate, whether or not people need that. But once you have enacted that strategy, now you have to find these people theoretically, or not find them, but have a mechanism, because at night they're going to go to sleep a shareholder in a mutual fund, and the next day theoretically wake up as a shareholder in an ETF. That means you need a brokerage account, because of course, working in the primary market with mutual funds exclusively, but now bridging the gap between the primary and the secondary market because you're listed on an exchange. So little nuances like that bring up the phrase or the cliche, simple but not easy. There is a pathway, as we have seen, but every case cannot be treated like a template. You have to take a deeper dive into each individual situation.
And I would build on that 100%, Mike. I think everybody needs to think about that individually, because even though there is a template out there, it's not going to be the same. Your shareholder base is going to be completely different and might not be appropriate for an ETF wrapper. The other piece of it that I would highlight is to continue to keep all the service providers in the loop, because the intermediaries are key there.
Oh, those are all great points. So let's talk a little bit about, you know, we're talking about, you know, if you run a mutual fund and some of the nuances of launching an ETF product today. So one of the things that we keep mentioning is the primary market. And so can we talk a little bit about, Mike, maybe first start with you with respect to building relationships with the market makers and the authorized participants. Maybe talk a little bit about those two parties and then how your ETF would interact with them.
Sure, absolutely. So if you kind of structure it out a little bit, you think about that, just to clarify roles and terms, that authorized participant is going to stand between the primary and the secondary market, performing a function, right, for the fund itself, as well as any type of, let's call it a client that the AP might service. Now, that client might be a trading desk within their own firm, where that firm has an AP desk and a trading desk, whether it's LMM or proprietary, or that AP may have a third party, a trading firm that doesn't perform the AP function. So a firm like Foreside has the ability to contract with them so they can perform this function. And a firm like US Bank, as a custodian and administrator, will be the ones to make sure that shares are issued and shares are redeemed in the proper fashion according to the ETF itself, according to the portfolio and the portfolio manager's wishes. We could do a whole webinar itself about the tax mitigation strategies that the SEC is now allowed in the ETF space, and to the benefit of everyone. But just going back to those roles, again, we'll all be working with each other, everyone from the exchange to the lead market maker, to what you might call secondary market making desks, to their chosen authorized participant. So it's our job in conjunction with Foreside to make sure that that conduit, that flow between the primary and the secondary market is set up just the way everyone needs it. Not just about the advisor or the fund family, but how does the AP want it to be done? And how does that client of the AP, that lead market maker or that secondary liquidity provider, because there's risk and there's balance sheets involved here. So you have to make sure that everybody has things set up the right way.
And I would add to that, to build upon what Mike has shared, I think what's critical to understand too, when you come from the mutual fund world, you're getting agreements in place with the intermediaries, to make them available on their platform. We get so many questions around, well, what type of, and we'll go into some distribution pieces with the intermediaries in the secondary market. But I think what's critical is, as Mike said, the authorized participants now are really going to be the necessary individuals that you are going to be engaging in agreements with, to kind of make a market in your overall, to kind of create and redeem the shares. So there's a whole new ecosystem of relationships that you need to build. It's more of the trading desk capital markets discussions versus a salesperson talking about, what your strategy is doing and to the end investor. But those folks are still going to want to understand, they're going to be specialists in certain things. They might focus on, more international equity, or they might work with, different, there's going to be evaluation of those. And that's where you need to think about too, when Mike was talking earlier about the series trusts and a standalone. If you're going in a standalone, you're starting fresh, and that's where it's going to be. The time frame is going to be more, Brett, as you noted. When you're working with a series trust, with something like, with US Bank, they have established authorized participant agreements in place already. So as you get in there, there's agreements in place already, and as part of that trust, you're leveraging that. So I think that's key to say, Mike, too, because, US Bank has established so many relationships, Foreside as well. And I think working together, as all series trusts do with their different service providers, they can provide those introductions. They can provide guidance around who might be best to talk to and begin those conversations, as well as help you build those relationships.
And Sonia, I think that brings up a great point you just mentioned with respect to the kind of the specialist in the industry. One thing that traditional mutual funds generally have portfolio management in-house and trading in-house. One of the things we've seen as a trend is really outsourcing that with respect to ETFs. I guess what is the reason where you would outsource the actual portfolio management and trading of the fund? What are some of the benefits of that with respect to an ETF?
And I'm going to punt over to Mike, because I think he's better served, if you don't mind, Mike, to answer that one.
No, not a problem at all. I mean, there's two components of that, Brett, that I think I can focus on. And, one of us brings us back to the trust level 1940 Act issues, right? You're going to a board, whether it's a board you put in place, or it's a board that a white label advisor put in place, or a board that's in place with the shared trust. And you're going to go to them with this sub-advisor and say, hey, we're working with them. We checked them out. They have the competency to make sure that this, for lack of a better term, this ETF doesn't blow up, right? And it's going to follow the 1940 Act. And we're going to be as tax efficient as possible for the benefit of the shareholders, because that's what's on the mind of the board. Everything has to be run for the benefit of the shareholders. So to demonstrate that competency in things such as helping you create the main PCF and all of the other PCFs that you'll use on a daily basis. Again, using just high level terms here, you could go into a whole other webinar about using these types of substitute baskets and pricing baskets and the let's say the normal create redeem basket for the day versus the substitute ones. So a little bit of skill in that, obviously helping you with that, making sure that you're aligned with the portfolio management strategy of your fund. But also on the other side of that, on the practical capital market side, they've got great relationships, right? And you're going to want to make sure that your sub-advisor can help you take advantage of every single opportunity to do a custom creation or redemption to mitigate capital gains within the confines of Rule 6C11 or whatever structure that you're following. These things are not a given. They're available to you, but nobody is obligated to step up on the other side in the capital markets and do this for you. Relationships matter, skill matters, and again, being able to have somebody that can help put that counterparty on the other side of this tax mitigation at ease in terms of risk. They may not know you and they may not want to engage with you, but a well-established third-party portfolio manager can help both the board feel comfortable as well as those third-party capital markets folks that you want to work with all the time. So that would be one of two of the benefits that I would cite on that. And if you don't have it out of the gate, these firms are great too. They can work with you for a couple of years, or they can come by, side by side with you and be a consultant. So they're very flexible on how they might work for you, with you.
You bring up an interesting point, Mike, that goes back to really the first question I asked, which was related to Series Trust, white label, standalone. I know you've seen it as well, but I've seen it too. Even large, asset management firms have made the conscious decision to go within a series trust for some of those reasons that you just mentioned. It's not that unusual to say, you know what, this is new to me. The ETF market is new to me. I want to go alongside somebody that's going to show me the ropes. And then if eventually maybe I want to, go out on my own, at some point I have that option still available. But for the first several years, first few products, this is the way I'm most comfortable doing it. I think we've seen that trend as well.
Yeah, I'll be really brief with that. Brett, I mean, look, if you come into a series trust, a shared trust with multiple advisors here at US Bank that's in place, you're not held hostage. We don't own that trust. Trusts are established, and then the board members, the independent board members, are the be all end all. They have all the say. They're charged with the responsibility of hiring advisors to run these funds for the benefit of the shareholders. So even though we started a trust and now our clients are utilizing it here at US Bank, if we fell down on the job, just like anybody else, it's incumbent upon that board to replace us. So I think that's really the key to it, right? Is making sure that that this fund is ultimately in the hands of the board, and all of us have that responsibility to perform our roles the correct way under the 40 Act.
Yeah, great point. Sonia, I know we want to get into marketing distribution. We're getting already some questions rolling in from the audience that we will get to, I promise everyone. But I want to get into, one other piece of the puzzle that once you've kind of gone through this process, one other thing that comes up is an investor wants to buy into the ETF, but they're seeing potentially some large bid-ask spreads. Who at the organization, at the ETF that's launching the product, who would they call with respect to, best execution, so to speak, of buying the product? And what are some of the conversations you've had at firms that it's like, this is this is the type of internal person that we need to handle these types of inquiries?
And it's a great question. I think it builds upon, a lot of what Mike has shared. You really need someone that understands kind of the capital markets and trading, and can kind of be the interface internally, helping investors to be able to implement the strategy. And I think we'll get into more of that as the marketing piece of it, or, kind of the end investors. But with the primary market and working with the authorized participant and market makers to make sure that the volumes they're able to keep the kind of the spreads tight. Those are all key pieces of kind of the ETF as it trades like a security. So you need that person who's able to interface in that way. That's going to be a new role for a lot of firms, because you have your portfolio manager who's managing the strategy. You're not really thinking about kind of how that's interfacing with the primary market. So really looking at kind of having someone on point internally that can manage that relationship, both with the primary market, APs and market makers, as well as investors, because I think that's another key as you're going forward and building out a sales team. Your sales folks can talk about a strategy, but an advisor may not know how to implement that. So that role can be investor oriented and education based, as well as helping you to kind of create an efficient market in the primary side.
Okay, well, I want to make sure we get into discussing marketing and distribution as well today. So I guess, Sonia, one of the things that I think we've seen is, marketing an ETF might be a little bit of a different strategy than a typical mutual fund. Do you want to talk about, kind of just your initial thoughts on putting together a marketing plan, distribution plan with respect to an ETF launch?
Sure. And I think, we started when Mike and I started the conversation, I think a lot of rings true is really thinking through this throughout the process, having an understanding that there's someone on the other side that's looking for your strategy in this wrapper. It's not build it and they will come anymore. And I think, Mike, you had it in a different words, but the same kind of sentiment. You really need to think about this as you're launching the product. So that's going to be critical as you're going out and kind of engaging with the primary market as well. They want to know that you have a plan in place, that you're not just launching a product that is just going to sit out there because, it's going to fail. From a marketing and distribution perspective, when you start to think about that plan and product development, you're looking kind of at yourself and where your competitive strengths are and what you're bringing to the market. You're looking at if investors, you're hearing from RIAs that you're working with that, this is a great strategy, but I'd love to have this in an ETF wrapper. So you're kind of starting with all that, and then you're moving through the process to really make sure that you're setting yourself up for success, understanding what am I going to need to build out to kind of grow this and kind of commercialize the product once it's in the secondary market. You really have to understand the intermediaries and where it's going to be available for sale. You're going to need to understand kind of that there might be additional roles and responsibilities that will complement your traditional sales folks to help you educate the marketplace. I think that's key too, where although ETFs have been around for a while now and they've grown substantially over the past few years, there is still a lot of education and a lot of new people to the space. So really being able to kind of promote that. Another piece of it is brand is very important. So getting the name out there, having that conversational alpha with, having your portfolio manager, like a Kathy Wood is a great example of that conversational alpha, telling the story around what you're bringing to market. So it's all going to be part of your plan. That is going to be kind of you're stepping through, making sure that you're going to have it available, and then you're going to have the people there to support it and have those conversations so that you can translate that in the secondary market into growing, assets under management. I know that was kind of quick, but I think it really points out that you need to think through it. It's a longer term process, and the fun stuff around marketing it and really, kind of working with service providers and other people that know what they're doing, such as Sunstar Strategic with, PR and marketing. That's all great, but you have to have that core around, I really need a strategy that's going to, kind of substantiate and extend the market and be successful.
Yeah, I think that's a great point. We've seen a number of ETFs, and this has been, well documented in the news as well, right? The number of ETFs launched, and then they've always quoted the number of ETFs closed. And some of that has to do with potentially not having the right plan in place and, not going through the entire process with respect to that. With respect to, I know this is something we get a lot of questions on is, what type of, transparency from a data standpoint am I going to have? With a mutual fund, I know who my underlying shareholders are. I know who's buying the mutual fund. With an ETF, how am I getting that data? Then how can my sales team and how can I compensate my sales team if I don't know where the sales are coming from? And I know that that's a question we get a lot. Is our mutual fund clients say, well, how do I get all this information and how do I put together, a strategy to sell this ETF then? So I just get your thoughts on that as well.
Yeah, no, it's one that we get a lot too, and it's a circular reference. Well, if I can't get the data, then who do I know is purchasing it? And then how can I, compensate or motivate my sales team to be able to sell that? So data is critical. And you are going to see a very different kind of world compared to mutual funds and that transparency. Where I do think you need to think about data is there are, ability through third parties to gather some of these data insights. There are also, the intermediaries themselves that are selling packages. Yes, they're very expensive. And no, I'm not saying that you need to purchase all of them, but really thinking through and understanding top of line that you may not have that, or you're not going to have that transparency. And if you do, it's going to be very nuanced, because every intermediary or service provider, there's going to be different level by office, by branch. It's not going to be something easy to work with to really compensate and figure out how to work with your sales team. So that's a component right out of the gate that you need to think about. Am I going to be able to get some data? And then how am I going to use that data to teach folks to get out there and grow assets and meet with those investors that are looking to use it? But also, how am I going to compensate and motivate them? And especially if I have a traditional mutual fund kind of staff that, hey, I'd rather sell the mutual fund. I'm going to get that transparency. It's going to be attributable to me, and it's going to be much easier. Where you need to think through that is, I think, really thinking around, I might need to do different kind of components for my sales staff. Is it going to be a base plus some, attributable number to what they are bringing in that we can attribute to a component of overall pool of net flows or attributable sales to other factors and metrics that, advisors, calling on folks and doing that regionally. So it's going to be a lot of pieces of the puzzle to put together, and it's not a simple process. And I think you have to go into it eyes wide open, that it's very important. Distribution is always one, people think about, well, I don't have the money to spend. Well, sometimes you're going to have to spend money to get some of that infrastructure to be able to get that transparency. So I do think it's important to understand it's going to be difficult, and that you're going to have to do things differently than you're kind of used to doing on the mutual fund side.
Mike, anything to add?
Maybe just throw something out there, like, Sonia, to tack onto that whole thing. I mean, get creative with the avenues that are non-traditional. And, one example comes to mind. There's a lot of trading firms out there that you would think as traditional market makers that also do agency execution of ETFs. So they do brokerage for large RIAs. It never hurts to be in touch with them, because anecdotally, you might hear a story about them, really doing a lot of brokerage for one of your ETFs for a specific RIA. And right there, they can be the source. If it's allowable, they can be the source of who that RIA is. And now you've got a direct route to talk to that RIA and say, hey, how can we better serve you? You obviously want to keep them invested in your fund. So just look for non-traditional capital markets-based avenues like that, where you might be able to glean some intel also.
Mike, I think that is so key, where you're kind of gaining that insight based on the new relationships you're building. And it shows the importance of kind of having the relationships on the intermediary side as well as in the primary market, because both are going to completely impact how successful you are in the marketplace.
And then Sonia, building on that, one of the other questions that is always top of mind is, with my mutual fund, I understand I have 12B1 fees. I know how to use those 12B1 fees for various platforms. But how does is an ETF on a platform? How do you get on a platform? Is there a cost associated with that?
Yep.
If there's no 12B1 plan in an ETF, then how is the platform compensated? And I know it's still very different for each platform, and it's still evolving, but do you have any kind of thoughts for the audience on that?
Definitely. And I think that's, definitely a critical piece of it. And we look to, working with our clients to really, add that value of providing some of the guidance around the platforms and points of contact. So early on, where am I going to day one list be available? And, you're not going to have to, as Brett, as you noted, you're not going to have to go out and get those agreements per se in place, but you may not be available because there's still going to be those barriers to entry and, the product development teams around ETFs have definitely continued to build out more robust kind of programs around how they support ETFs on their platform. That being said, typically when listed, the custodial and clearing platforms typically make, I would say passive and active funds available. I think the new non-transparent, semi-transparent wrapper is still something that I would put kind of over here in another bucket, because folks are still thinking through, all right, are we going to be able to, we want to see this kind of play through, and is it performing as intended to do? Are the bid-ask spreads tight? Are the volumes there? So that's still a wait and see approach with the intermediaries. But an interesting factor there is Schwab has come out, and they have been the first one to dip the toe in the water, where with one of those wrappers, you are going to have to get an agreement, and you're going to have to pay some, an asset-based fee to kind of make it available. So that's a new kind of entry, and that's where I think it's always evolving. And having those conversations as you're onboarding with us and in US Bank, we're happy to share those insights as well. The intermediaries, the RIAs, the individual investors on those clearing and custody platforms, those are going to be your initial folks that you're going to be able to get out to. You're not going to have to, do anything. As you start moving on to the IBDs, to the wirehouses, they definitely have full due diligence, full research coverage on the wirehouses, thresholds from an assets under management, thresholds from, overall performance track record and such. So it turns into very similar requirements that you've seen on the mutual fund and you're very well accustomed to, but the agreements there are not as much a factor. You're not have to worry about getting that agreement or paying. You're gonna have to pay for data. You may have to look to pay for, and not as prevalent anymore either, some of the NTF programs where everything's commission free. Those kind of went and dissipated as well, but Pershing still has one. If you can get on their NTF, their fund vest for ETFs, that's something that's maybe worth kind of shelling out some marketing dollars for. But definitely a different universe, but important to start framing out. So the worst question we get is, well, they just launched and they want to know why their Merrill broker can't buy it. Well, they can't, because you're not available even unsolicited Merrill. So that one would have been out of the gate, knowing that you're not going to be available there. Pretty important probably to you. So really kind of there is a kind of hierarchy of where you're going to be available and the ease of onboarding those platforms early on.
Yeah, Brett, I might add one other quick thing. It's your point, Sonia. You've gone through all the conversations, you've gone through all the product approval, and you're ready and you're convinced that the green light is on at your destination. And then you still get that call. I just put in your ticker and I wanted to buy 1,000 shares. I couldn't do it. So please, please, please make sure that that approval team is communicating to the operations team and they actually have uploaded your ticker and they do have everything in there, because obviously there are two different teams performing that function. And we've seen that many times. Hey, Mike, I can't understand. My clients can't buy my ETF and they told me I was approved. Well, just make sure those internal teams are talking to each other so your ticker is available at launch where you are approved.
Because it can be very frustrating, and we completely understand as a service provider and working with you and Mike and his team and Foreside as well. We try to, kind of call out all the potholes, but there's a lot to learn as you're going through it. So make sure you're well aware of what, kind of is going to be out there once it's listed. There are going to be differences then, on the mutual fund side, some good ones where you don't have to get that agreement, but on the flip side, you still have to work through the due diligence requirements. So
it's a long-term commitment, right, Sonia? I mean, it's not going to happen overnight. It's potentially a multi-year process. And so
absolutely. But work with the investors that can enter it and put that plan together so that you can get out to those RIAs. You can get that branding or that marketing where you want to, kind of connect with maybe the individual investors that recognize your great brand and want in on, kind of your thematic approach or whatever you're bringing to market. So you have to work with what you have as your target market initially and build upon that as you kind of grow and are able to make it available to different intermediaries.
We have a number of questions that rolled in, so I have another question for the panelists, but I'm going to pair it with one of the questions that came in, and I'll start with my quick response, and then be interested in Sonia's and Mike's. With so many new ETFs, is there any room for competition? Any more room for competition? You know, I remember thinking that 10 years ago. Oh, well, there's so many ETFs out there. There's so many index ETFs. Well, you can't have another index ETF. From my perspective, the way that ETFs are launched now, there's almost infinite possibilities of new products that could still come to market. That's my initial thought, was there is still lots of room out there, but Sonia and Mike would love to hear your comments.
Yeah, and I mean, I'll just jump in. I would agree. You need to be innovative, though. I don't think we need another large cap core that, you know, kind of, you know, you don't need a standard that there's many other things out there. You need to be innovative. You need to be thinking what the market wants. And as Mike brought up early, you need to be partnering with the intermediaries to understand what they're trying to solve for, so that you can bring to market things that are going to be successful.
Yeah, and I think some of the things that, you know, we've seen recently, obviously thematic, you know, these defined outcome products have been very popular. And obviously, you know, on the active side, you know, Kathy Wood's, the ARC ETFs have been very popular. We're almost seeing, you know, the thematic ETFs with respect to betting and things of that nature. We're seeing. Yeah, yeah, exactly. And you know the ticker off the top of your head, and you know, so does everybody that listens to Barstool Sports. So it's almost like, you know, some of these have become like we mentioned earlier, almost a technology play, where the, you know, the Robinhood platform investors have really jumped on the bandwagon of those types of ETF products. Mike, do you want to comment as well?
Yeah, you know, so I'll be quick with this part, but I remember the days of when you talk about core and satellite investing, right? And now we're talking about, you know, beta and thematics. But what still remains, and you both brought up iBet, for example, right? If this was years ago, someone would talk about the S&P and then sprinkling it with larger allocations to the GIC sectors. You know, those were your themes, right? I'm going to turn this knob, turn that knob, dial this up, dial that down. So the responsibility of the product sponsor to show the end client how this fits in their portfolio has never gone away. How it increases the volatility, where it can add alpha. Is iBet a substitute for, you know, leisure and entertainment, or is it a tech play? You need to be prepared to show these people, if you come with the theme, you're not just rolling the dice. You're not just stepping up to the table and hoping that over the next 6 months, the ETF is going to go up by 50% and they're going to get out. ETFs are great trading vehicles, but they are funds at their heart. And we need to build this long-term case and try to shed this persona that ETFs are just for trading, if they're going to replace mutual funds, which have traditionally been long-term investments. So even themes have a place there, but you need to be prepared to show folks where this fits into their portfolio in the long haul, not just the short term.
Yeah, Mike, and I think that goes back to the education and the kind of investor conversations, where it's not just about the theme, but how it's going to be incorporated into the overall strategy, and, you know, kind of to make yourself successful. So I echo that, you know, 3,000%.
Yeah, and that you're bringing that product to market, and you're a specialist in that particular area. You know, Sonia, this one's for you. Would you suggest marketing an ETF to the same audience as a mutual fund, or does this open up new opportunities?
I think it's both. I do think, you know, if you launch an ETF and, you know, you're new to the ETF space and you have mutual funds, you may gain, you know, some folks that are looking for the ETF wrapper. It's going to depend on the underlying kind of, you know, client account. You know, is it a taxable account? Is it qualified? You know, so there's going to be a lot of pieces there. You really, again, it's maybe think before you launch it more, is there demand for the wrapper in what I'm bringing to market? And then it's going to really already tell you who's your target market. So you may gain some new individual investors who are really looking for this. You may gain some, you know, ultra high net worth, you know, RAs that have ultra high net worth clients that are looking for that tax efficiency. Maybe they're not utilizing SMAs. You definitely have, you know, kind of the importance around understanding where it's going to be marketed, but you're going to gain new, and you may, you know, kind of stick with some of the old that are just looking for the new wrapper.
And I think that leads into this next one for you, Mike. why would you convert a mutual fund / SMA to an ETF instead of just creating an ETF mirroring that ETF or mutual fund / SMA?
Yeah, so I just had this conversation with the client 2 days ago, and the actual, let's put it this way, their path that they're going to take is actually the latter. And some folks call it a clone fund. Fine, let's just call it a clone of your existing mutual fund. But their point, and the point that Sonia was making too, is well taken. If you've been around for a long time and you've had a successful mutual fund, chances are demographically, there's going to be a subset of your AUM that has no interest in moving to an ETF. And if you did force them to convert, they'd either be gone, they wouldn't stay with you, they wouldn't like that. So you really have to take a hard look at what would happen to the legacy mutual fund if you converted it all at once, or as you were mentioning here, are you going after a new investor subset, whether it's demographics or just online investors? Are you trying to get into a portfolio allocation that where your ETF can slip right in, but your mutual fund can't? So if you have the wherewithal to run both at the same time and make them profitable, for me, I can't understand why someone wouldn't do it, right? The end goal is to have a profitable fund that's doing well for the shareholders. And go back to the beginning of that, Brett, really quick. Those who see the value, like a DFA, for example, I guarantee you with the folks that they brought on board there to do this analysis, shouldn't say guarantee, I have a strong belief that they felt that, yeah, our DFA clients are going to love this. They're going to love tax mitigation. They're going to love the ease of trading. We're going to make sure that these are going to be highly liquid products. So for them, that question was answered with a high level of certainty, and they had no angst about saying goodbye mutual fund, hello ETF. But there are absolutely those who are still in the middle. Why would you forego those anchor clients who've been with you forever, who still want a mutual fund? For goodness sakes, there's still unit investment trusts out there in the marketplace. So those were supposed to be gone years ago too, in some people's estimation. So it's all about the needs.
I would say, I mean, you can see it in the marketplace. Lots of large players now launching ETFs, and they have a very successful mutual fund business that is going to continue to be successful. So it's definitely a consideration that both wrappers are being vehicle agnostic as you go out to the marketplace is a very, kind of successful strategy. If you have, kind of successful, or you have good strategies and, kind of good end investors that you connect with, you can be successful in that regard.